Now, we've seen a free fall in the past 2 odd days, and you as an investor or you as a trader, what should you do next? What changes should you make in terms of where your portfolio stands? Should this be a buy on the dip strategy? All of these questions are going to be answered in this next segment. And to take us through all of these questions, we are joined by Sachin Relekar, who is the equity fund manager at Axis AMC, joining us now. Sachin, thank you so much for taking out the time. My first question, probably a worry that a lot of investors have right now, is with the kind of free fall that we've seen. A lot of people know that this is on account of geopolitical uncertainty that's going on. You know, we've seen European markets 2 days straight of red. We've seen Asian markets also not, cheering the kind of commentary coming in from the world leaders, but just want to understand as to what is happening, and as an investor, should one be worried or this should be a buy on the dip strategy?
So, as you're also alluding to certain things, what is happening is the genesis of that is more towards the global uncertainties. Rather than there are anything to do with the domestic situations per se. We have a very stable policy environment. We are likely to have a budget on the first of the next month. So those things are happening as per the expectations. I don't see any major policy changes also to happen in the near term or even in the medium term. These are something which are continuing for last more than a decade. Also, the reform direction domestically has picked up quite a lot. So those things are there. But at the same time, globally, if you see, there are a lot of uncertainty, starting with the change in the administration in US, and that has come out the change in the policy towards the trade, towards the geopolitics, and the shifting of macros is actually in alignment with that. So what we're seeing now, and some of that actually we are seeing in last year, April 2nd, 2025, when the reciprocal tariffs got announced first time. And that time also global markets reacted very in a jittery fashion. And now I think the similar things are also again playing out. If you closely see what exactly has happened is the hard currencies are actually depreciated. The dollar has depreciated against the dollar. The capital has moved into the safe haven asset like gold. It's the strongest performing asset class in the last 1 year or so. And followed by that, the industrial commodities also have performed quite strongly. The reflection of that is actually the weaker currencies is there. And this also has an impact on the long term or the riskier asset class, wherever some element of uncertainty is there, which is where the equities have got impacted. India also is going through a trade negotiation, and there is some bit of a delay or some bit of a versus expectation, some kind of uncertainty is there in the minds of investors, and that has affected the Indian markets to an extent. But however, the majority of the fall in the market in our assessment is actually explained by how the global macros have shifted and how the discounting rates or the risk premium, which is reflected in the long-term bond yields, is actually affecting the valuations over here. And the other part of your question was how investors should respond to this and how they can adjust. So basically, all these things need to be taken into account. But at the same time, as I started with saying that the domestic outlooks and where our focus is majority has remained unchanged, and we had seen in the previous major crisis also some of these things actually sentiment-wise also change also very fast. It's unpredictable. I also have to say that, but I don't think the outlook-wise from a company position point of view has changed very drastically because of this. There are companies which have linkages or direct impact from trade negotiations, etc. But overall listed space does not have a very large linkage. And therefore, I think one need not have to be really defocused from the investment framework or the discipline which is there.
Understood. So then, Sachin, you talked about valuations, but do you think that the current correction that we've seen, and even 2025 was an year of consolidation, right? Do you think now there is some comfort in terms of where valuations stand?
You see, large cap valuations are closer to the long-term averages. That's not a discomforting space. First of all, I'm talking about the top 100 names. The mid-cap valuations also have moved or ticked down, like they were about closer to 2 standard deviation from the long-term averages. and it has actually also ticked down quite a lot. In certain names, actually, in our assessment, also we are seeing perhaps the downside wise, unless we create a very bearish kind of outlook, they will not actually show that kind of price correction further on a fundamental basis. Of course, the sentiments can weigh on the share prices in a different manner, but in that sense, that portion is so the valuation concern by and I'll say at least in top 100 is not very prominent. In next 150 names or the mid cap bucket, there is some improvement in the valuation comfort. Although there are expensive names, I will not deny that. I mean, there are expensive names, although they have a growth rates or the growth expectation is also very high. But from where we are, maybe 1 year ago or 2024 end to now, of course, the valuation has improved. In small cap, I think one cannot just go by one parameter because it's a very large universe. I mean, anything beyond 250 is actually a small cap, and it's a very large universe, and therefore it's actually becomes very individual company specific. And over there, if I just take that same barometer or same measurements, then perhaps the valuations are not cooled off as much. But as I said, the individual names can differ quite a lot in that segment, and that basket is much wider. Perhaps I'll not use the same parameter over there.
Understood.
So leaving aside that, at least for the top 200 or top 250 names, there is some bit of valuation comfort which is there. What is weighing on right now is more of a sentiment, in my view. I'm not calling like things are going to change in a quick fashion, because these macros shift which is happening perhaps can be a long term, because there's a policy change which has been talked about, is quite radical also. Right. I mean, some of these things are actually getting questioned there.
Right, got it. Sachin, so do you think that the earnings cycle has now bottomed out and we will now see the recovery going forward? We're already in the middle of Q3 numbers coming out, and we've seen some positives coming in, right? It's not as bad as it was in Q1 for that matter, or Q2 for that matter. What is your reading?
Certain. So I think the large caps IT numbers have been there already, most of them. Now some of the mid caps will also start reporting. You are seeing the print is actually slightly above expectation, not below expectation. The commentary wise, although it's cautious, but there is of course some kind of positivity around it. Not a great positivity. Nobody is calling out double-digit revenue growth, etc. But all that is predicated on what is happening to the budget finalization, which will get finalized for the US clients over there. So yes, there is a cautious optimism which is there. I will say caution is more than the optimism, but still that cautious optimism is there, and that is one basket. So that which has actually given a positive outcomes or positive results. Stocks might have reacted differently depending on what was built in for the expectation, but commentary wise and what number is versus the expectation when we started September was much better. I think similar thing can be talked about financial results. They have corrected some of the companies which have reported numbers, but if you look at the stability, the earning quality, so all those parameters are good. So banks have reported healthy growth, the margins have been much more stable, and the asset qualities have actually continued to be very stable. So all the three parameters which matters for the financial names or the lenders per se has been quite healthier. So those are the buckets which are reported. So in a way, the outlook on just from those names is not suggesting any kind of negativity per se. Now, as we progress, of course, more companies will report, and so I think what you're saying in terms of the bottoming out, I think they are not like any major upsets on the expectations so far. So it should move in line with expectation broadly. And as we'll see, perhaps we will also have certain things which will come into the place over a period of time, which has become a bit of unpredictability, which is trade negotiations, all those things. That will actually also improve a lot of sentiment around it. And that will give the spillifs to the sentiment as well.
Okay. Sachin, a lot of sectors have already seen a lot of growth in terms of where the stock performance is concerned, especially something like metals, right? So many counters have seen the uptick that we've seen in the last couple of months. what all sectors are you going to be watching out for 2026? One thing. And secondly, would metals still be on your radar considering the run-up it's seen in the past couple of months?
Yeah, industrial commodities are definitely on our radar. Although our ownership in that space is very minuscule as of now. We the way we look at it is basically we are just looking at the bottom of argument also for the individual companies to buy into. While as I said, the hardening of bond yields or depreciation of dollar per se is actually reflected into the precious commodities rising, and that is also followed by industrial commodities which are continue to go up. Uh, the one way of hedging that is either by the mining stocks which are into those commodities, which are unfortunately is not available in the Indian listed space. And then there is a industrial commodities like aluminum and maybe to an extent silver, which is where one can allocate. We are, as I said, we are that is something we are watchful about, but we are also assessing the bottom up arguments in that, and perhaps we're also looking at the what is the long term averages for the metals which have been projected by the global analyst also, and how much is that is factored into the valuations. These are some of the things which are weighing, that will continuously be watched out for sure. And not only from owning the commodities per se, but what is the kind of impact of those will be there on the industrial names, automobile names. That risk assessment also is to be done. So there are both aspects of this. So we are watching that. As of now, our ownership is little less, but at the same time, we are also more watchful about the risk to the earnings or the margins for the users of those commodities. That's how we are looking at it. In terms of the sectors which we are keenly or where our allocation is slight overweight compared to the index are consumer discretionary. Within that, there is automobile, there is consumer internet also, and there are certain platform companies also are there. This is one of the key under overweights. Followed by that, we are also quite overweight in defense and industrials wherever the energy transition themes are there. Those are the places where our allocation is meaningfully higher than the benchmark.
Okay.
These are some of the things which are watching very carefully. Financial is another important segment for us to be watchful about.
So Sachin, then is 2026 going to be the year for large caps still, or will the recovery in mid caps and small caps take place in 2026?
I think recovery in mid and small caps, the way we are looking at, is going to be very, very name specific and a very, very selective basis. Companies have a showing a clear break from the past in terms of the earning growth or in terms of the improvement in the visibility will be the ones which investors will favor. That is how we are also looking at that. But at the same time, large caps is more steadier and more predictable space, something where the volatility and the earnings is likely to be less. And of course, as I said, the valuation comfort is better. I think that is something obviously will be a major portion where we will also allocate. At the same time, I think the uncertainty which is emanating from the shifts in the macros, that I think is likely to be a little more longer drawn out, because some of these steps and some of these agreements negotiations are going to continue,
Right.
and according to that, things are going to remain reactive to that or volatile to that. So that also need to be watchful about.
Okay, Sachin, thank you so much for giving us those insights, and I'm sure viewers will now understand as to how all of these factors are going to impact their portfolio and what they can expect from markets in 2026. Thank you so much for taking out the time and helping us understand everything that you just said.
Thank you for having us.